CFPB, or Consumer Financial Protection Bureau, just released their final ruling on QM, or qualified mortgages, last week.
All the LOs just sat up, and all the realtors just went and said, "What the
heck? Dude, what the heck? It's a family show.
Anyways, LOs already know what we're talking about. Realtors don't click out as this pertains to your clients as well, just on the lending side of things.
The ruling may just cost you your next closing. Probably not though, but now that we have your attention, let's talk about what this really means for you and I.
QM is short for qualified mortgage, and it's basically a safe harbor for lenders that write loans qualified under the new QM guidelines.
Now remember, this is a response to loose underwriting guidelines and procedures way back from the early 2000s. And yes, I know this is 2013, and yes, I know it's a bit odd that this is just now coming out, but let's give them the benefit of the doubt and see what this is all about.
So the final rule contains the following elements at minimum. Now, creditors must consider 8 underwriting factors.
Okay.
1. Current or reasonable expected income and assets.
Like a verification of employment and bank statements? I think we pretty much already get those.
2. Current employment status.
Again, part of the VOE process, we all send out verifications of employment to verify employment and income.
3. Take into account monthly payments on said debt.
You mean like the DTI calculation, right? Like the ratio that all lenders already calculate?
4. Take into account revolving debt.
Again, in the DTI calculation. Wait, did these guys even know what we do?
Apparently not. 5. Take into account mortgage-related obligations. 6. Take into account child support and alimony. 7. Take into account residual income.
Wait, did they really just say the same thing from item 3 through 7? They could have just said DTI and limited their 8 criteria to 3 criteria. That's so government for you, that's hilarious.
And finally, number 8, credit history.
Ah, great, now we gotta check credit scores? What are we gonna do? Wait, that's what we've been doing all along.
Also, NEGAM, interest-only balloon payment more than 30-year and no doc loans will not be considered qualified mortgages.
Okay. Gone long ago, limited, gone, and yep, gone. We haven't done those loans since this mess started 7 years ago.
And the big kicker, a max DTI ratio for new borrowers is 43%.
Okay, that one we need to take serious. That's a big one, especially for first-time homebuyers. That will limit the amount they can borrow and push anything above a 43% DTI out of a qualified mortgage status, thus removing the safe harbor from the lender that makes such loan.
Also, apparently all loan fees, including LO compensation, cannot exceed 3%.
What? Actually, it's a bit unclear as to whom this will affect. It appears this will unfairly only affect the broker world, but don't quote us on that. I'm not sure that the industry has figured that one out yet.
Lenders will have until January 2014 to get used to the new old underwriting guidelines. This is when the rule officially will take effect.
At which point, a 7-year transitional period will go into effect, and I'm not even kidding, you can't make this stuff up.
On a serious note though, the changes will keep coming this year. As we said, a second term for our current president will all but ensure these changes continue. The CFPB is here to stay now, and they're tasked with implementing Dodd-Frank, which of course was written in response to the foreclosure problem.
Hold on, this is just the start. There are many more changes to come, but don't worry, as long as you're subscribed to the show, you'll stay informed and be in the know.
We'll see you guys next week when Ryan attempts to gouge out his eyes from all the crazy legislation.
Yep, and a CFPB quick fact sheet is available down below. Share your thoughts and share this on your page as well with the new and improved share buttons. We'll see you guys next week. Can't do it. Can't do it anymore. I can't take it. I can't take it. I can't take it anymore. No.